Thank you, Mr. Chairman. Chair Yellen, in your testimony you mentioned that you currently anticipate that the federal funds rate will continue below levels that the committee views as normal for an extended period of time. You also added that depending on economic outlook, this rate increase could occur sooner or later as we get a better feeling for the strength of the economy. Based on your view of the economy and the markets, when do you currently anticipate this first rate hike to occur?
Well, the committee has given guidance that says what we will be looking at is the progress we're making toward our two congressionally mandated objectives, maximum employment and price stability, or our 2% inflation goal. So there's no formula and there's no mechanical answer that I can give you about when the first rate increase will occur. It will depend on the progress of the economy and how we assess it based on a variety of indicators. To get a sense of the views that members of our committee hold, included in the monetary policy report is a summary of economic projections that all participants in the FOMC provided at the beginning of our June meeting. So these projections are just that. They depend on each participant's own personal economic outlook, and they are not a policy statement of the FOMC, but they provide some sense of concretely what participants expected at the beginning of that meeting. And those projections show that almost all participants anticipate that the first increase in the federal funds rate, if things continue on the trajectories they expect, would come sometime in 2015. And the median projection for where the federal funds rate would stand at the end of that year was around 1%. So a positive but relatively low level. And I think that gives you a feeling for what participants thought would be appropriate given their projections in June. I want to emphasize, as I've said repeatedly, that what actually happens, our projections change with incoming data. The economy is uncertain, and what will actually happen clearly is going to depend on the progress the economy makes. But I think that's consistent with the forward guidance that's contained in the FOMC statement as well.
Thank you. And based on the minutes of the most recent FOMC meetings, the discussion of monetary policy normalization has become an important topic for the committee. One of the strategies that is discussed is that the Fed will drain reserves by lending its securities out to the market as a part of reverse purchase agreements or repos. There's concern that such a facility would be a safe haven in times of market stress, attracting large funds and depriving business of credit. Is this a concern of yours, and how would the Fed address the potential that the facility could aggravate a market crisis?
Well, let me say that these are matters that we are discussing in an ongoing basis, and no final decisions have been made about the precise strategy that we will use when the time comes to normalize monetary policy. But we've tried to provide in the minutes a very good summary of the thinking in the committee as these discussions have taken place. One of the challenges we face is, as you mentioned in your opening remarks, the Fed's balance sheet is very large. There are a very large quantity of reserves in the banking system, and because of that, that poses some limits on our ability to precisely control the federal funds rate. We can't really use quite the same strategy of intervention we used prior to the crisis. So we've indicated that the main tool we will use is the interest rate we pay on overnight reserves. The overnight RRP facility that you referred to, I think of as a backup tool that will be used to help us control the federal funds rate, to improve our control over the federal funds rate. I think it's a very useful and effective tool. We have gleaned that from the initial testing that we've done. But as you mentioned, we do have concerns about allowing that facility to become too large or to play too prominent a role. And for precisely the reason that you gave, if stresses were to develop in the market, in effect it provides a safe haven that could cause flight from lending to other participants in the money markets. So two tools that we can use and are discussing to control those risks. One would be to maintain a relatively large spread between the interest rate we pay on overnight reverse RPs and the interest rate on excess reserves. The larger that spread, the less used that facility will be. Also, we can contemplate limits on the extent to which it can be used, either aggregate limits or limits that would apply to individual participants, and all of that is figuring into our discussions.
Thank you.